Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for the next 20 minutes here on Options Guide TV. So it is the week. It is the week of the earnings season, and over the last 2 weeks, we have about 800 companies that are announcing earnings, and more importantly, we have the Meg 7 that has kicked off with Netflix. Netflix was uneventful overall, but it's all about Warner Brothers and their deal that they have going on. I really hope it works out for them. I hope that they do get that opportunity to purchase that. I think Netflix would be a good owner of them. But with that overall, it's really holding down the stock. I do see it as a buying opportunity. The downside is with Netflix that how long is the process going to take? And then ultimately, in the end, will they actually own it? So there is risk in the Netflix in that it is a stock darling. We're not worried about tariffs. We're not worried about growth. They're showing the growth. Disney's trying to figure it out as far as their online presence, but Netflix by far is the leader in that space. And so with all that said, I do like Netflix here, but it's not an option play per se. We have a deep in the money call option on it. But if you buy and hold, if you got a 5 to 10 year outlook, Netflix is going to come back no matter what happens with their deal that they're trying to negotiate. But I digress in that. We did a trade in Uber, and Uber got beat up today. It's down 3.5%. So not that big of a deal, relative, because Uber can move 3.5% pretty easily. But they had strong growth, but they fell short on profit expectations. They do got some regulation hurdles and things going on. I think Uber overall is a solid stock, but we did a $1 open wing butterfly, and right now that trade doesn't have much in it. It is centered around 82. We see Uber trading at 75. So we had a risk quantified, right, limited and known by of $1 for our butterfly that we put on. It was fairly inexpensive. Now, obviously, if you went out and bet the house on it, there's not much left. There's not much to do in Uber. Bottom line is the earnings weren't good and the stock went down. Okay, so overall, a lot of our butterflies have done very well over earnings, and we've leaned to the bull side, and that's mainly because the markets have been bullish. I think they're right now. We got the VIX still hanging out around 16, 17. We still have a lot of events that are happening. We finally got the Fed chair announced, and there's going to be a process of vetting the Fed chair that's going to happen. We have the payrolls coming in on Friday, so we have jobs numbers coming in Friday, and I think that's going to be probably the most looked at number in a while. For first time, we finally got the data out and all put together. Government shutdown, nobody even mentions it, so I don't know if that's even a thing. It's so weird that the government had the potential to shut down and it doesn't even make the news headlines. So it was a partial shutdown, and there wasn't much power that Democrats could control, just because a lot of the things had already been negotiated. They could have been annoying, if you will. So I think the path of least resistance is to the upside as far as the markets are concerned. The one stock that believes in that is Google. Google has been just, the stalwart of the market. Everybody was worried about what they were doing with AI. Their Gemini is now, leading. They're offering it up to people for free. Every one of them have a, you pay more, you get more scenario, but Google is doing extremely well. The burden of the antitrust once that popped off of Google, never really realized that had probably more to do with Google just not living up to its potential. Now the company has done well. So let's run to the Tradier Pro software, and they're announcing after today. And so you're tempted when you look at the chart, and I'm going to pop up the chart first, is this is a pretty big ski hill, right? This is a black diamond. If you're a ski enthusiast, got a couple of big moguls in here, but boom, that stock has just skyrocketed. And we're getting a little bit overextended to the 20-day moving average. This is all the way down here at about, well, right now 235 with the market trading at 334.07. I think that is probably my biggest concern, is just the fact that it is potentially getting overextended. And a stock like Google, whenever the company comes out and announces earnings, they're not flamboyant in the way that they handle their conference calls. So a lot of times the stock doesn't necessarily react as well as it might. It's not like Elon Musk coming in and saying, yes, Tesla is not selling cars anymore, but we are going to have robots and they're going to take over the world. And usually Tesla has a tendency to go up because of the rah-rahness of Elon Musk. We don't get that with Google. So I'm kind of leaning in this instance that we might see a little bit of a sell-off. And we got a 2-day trade. Right now we're down about 1.3%, but I don't think it has anything to do with the fundamentals. So my thought on Google might be that, this is probably actually I need to trim some of it. My largest holding is in Google. But in the short term, I think that either we can. I'm gonna give you two trades. I'm gonna give you two trades, and I literally am gonna flip a coin. I think they're gonna have a great quarter, but it doesn't necessarily mean that the stock is going to go up. But I do like to trade Google. It's announcing on a Wednesday. You got all day Thursday, all day Friday. You see this up. We're seeing a little bit of a sell-off today. Markets are just kind of meandering around. S&P 500 index is down 10. SPY is down 1. And, so markets are flat. VIX spiked a little bit. If that is that correct on the VIX? Yeah, we still got so that's nice. No longer are we seeing the derived value on the VIX. This is the actual VIX index. I kind of that is interesting to me. So I still wanted. I have a long position on in the VIX index. I actually didn't even look at the VIX this morning yet, and I have some long calls in the position. I'm going to have to go and look at that. All right, I digress again. Let's go back to Google. Google 333.56 down 6 on the day. Let's lean into the bearishness going into the earnings. Let's start with that trade. And I'm just going to do a couple of butterflies. And, if we can get the butterflies done well enough, I don't know. I think we're just going to have you look at the Tradier Pro software and you can put trades on for no commissions if you got the right plan and everything. But you still got to pay the fee, or you still got to pay the bid-ask spreads. But I don't know if I mind kind of going either direction here on Google. Let's look at the chart one last time. Zoom in over here. 1 second. Let me just pull it back to the normal. We're not even really in a period of consolidation, are we? I mean, we're staying above the 20-day. We're staying above the 50-day. We're just getting extended on the 200-day. 350 is the most recent, 20-some points higher. All right. Let's go this way to start, and let's see if we can keep this. I wonder if we can get it done for under $3. Okay. We're going to buy the right now. Here's the February expiration, 2 days away. We have an expected move, and I'm just looking at the intrinsic value, $10 plus $10. So you're talking about a $20 and a quarter cent expected move, which usually you can tell by looking at about the 20 delta. Okay, so yeah, $20 is right about where the 20 delta is at. So all the numbers are working out because it's a very efficient market. But remember, the expected move is you're just buying the most at the money call and the most at the money put, no regard to direction, but you're just basically taking the option prices and making an over under market, if you will, on what Google might do by that Friday expiration, February 6th, 2 days away. So with that said, we're going to go in and we're going to stay within that expected move. The 30 delta is always kind of like what I like to try to target, just because there's a high probability of at least reaching there. And we're going to make it open wing. So if it continues on up, we can still be profitable on that trade. 320, 330. Yeah, let's do it. Okay, here we go. Buy, sell 2, buy 1. Yeah, that I don't mind that. So that's 243. Send that to the what if calculator. That means if it goes below 315, if that does happen, we can make 250, about 260 to be blunt. So let's send it to the what if calculator. It's 242 right now. No, it's going to grab that 245 probably. 245. Let's bring it down. And I'll show you everything that I just talked about and where I got those numbers from. Okay, so this is 10 points wide. This is 5 points wide. This is the long spread. This is the workforce in your open wing butterfly. This is what makes you money. This is the short spread. This is what lowers your cost, manages your risk. The short spread is shorter than the long spread. Because of that, this trade can be profitable if the stock goes beyond the 360 level. We're paying 245. Let's call it 245. Let's just make the math real simple. Then this will be our official paper trade. We're paying 245 for it. And so down here, it's even saying that at expiration, if we're anywhere below that, it's going to trade for 5 minus 245. And right here it highlights we would be up $2.55 on this trade if we got the market to go in that direction. Now, if the market goes above, if it's a positive trade, we lose the 245, and that's all that we can lose. Maximum we can make is if it goes right to the precipice and stops. You got 2 days for it to happen. A lot of volatility, a lot of premium has to come out. So if it lands right there, the maximum we can make is $750. We'll call it $750, which is, you can highlight it right here. Now, to start with, this is showing all the vol premium. Eventually, that has to erode, and that's what makes it interesting to do these type of trades around earnings, because you're selling so much implied volatility premium, and it's got to go away in 2 days. You got an expensive underlying, you got a volatile underlying only because of the earnings. Google in general is volatile, but it's not extremely volatile, right? It's not a, I guess I'll say semiconductor stock. I don't know what else to say. Something that's extremely volatile. I guess Google's a little less volatile than Nvidia. On a general basis. Okay, here we go. Let's look at the long side. So this is the one butterfly to the downside here. And then let's go on the long side. We could do a couple of things. I like playing with Google. I like the fact that it's a $300 stock. I wish it was on Thursday. Sometimes they announce on a Thursday. Amazon always announces on a Thursday. I don't know if they got a good happy hour after their announcement or something. Maybe it has to do with their location, but they always announce on a Thursday. Okay. So if we take that same plan and we try to sell the 30 delta on the call side of things, we're going to look at probably the 350. So let's go 340. Sell 2 of the 350 and stop short on the 355. Yeah, 220. Okay. So our total cost would be close to $5. So if it lands in the middle, so this, I'm just thinking, like, what if we do both of them? But we only make a smidge if it goes way up to the upside. Never done that, never even proposed it. Probably should have thought more about it before I got on the show. But so now on the opposite side, this is if I was looking to do the butterfly on Google right here, the precipice up here, what is that, 780? Well, it's 220. 210. I think it grabbed 220 when it came in. And when I say it grabbed 220, that means the profit and loss calculator bought that. So this would be 285. No, it was a little less than that. 220 would be 280. So 285. So it's 215 that it picked. And that's the price that it grabbed when the calculator came in and made all their profit and loss graphs at expiration. So it's 215 that it grabbed. This would be worth $5 minus the 215 means you make 285. If the market skyrockets to the upside. If it hangs out in the middle, once again, you miss out. So you would need the stock to make a small move to the upside or a small move to the downside. You have this precipice here. So if you combine both of these trades, you got $5 of risk, and the only place that you really lose is in the middle. It's an interesting trade. But if you want to lean one way or the other, I would truly believe that it's a coin toss. I think they're going to have good numbers. But I mean, I own a lot of Google. So if I'm going to say the path of the least resistance is to the upside. So I'm going to lean into the call trade, and we'll make the call trade the paper trade today. But I find it a very interesting trade to do it this way. Now, if I wanted to lean negative, right? I don't know if I'm going to be able to get enough. The other trade that I like in the butterfly space, and if you have any questions, please do put them in the chat box. I always forget to mention that. Happy to address anything that you have. Oh, there you go. We can toss that one out there. Good morning, Kurt. Hey, I hope you rolled your FedEx trade. Oh my gosh, that stock just decided, I don't know, almost like it had takeover rumors in it, the way that the stock moved today. We talked about it on Monday on rolling it. We should have rolled it on Monday. Now I'm forced to close it. As a matter of fact, if you want to move, I actually have a closing position in on FedEx right now. It was a very good trade, profitable trade, but the stock there was no chance to roll it because the stock has just taken off. Where is FedEx right now? 362.42. It's up $9 today. Look at that type of move, right? And remember, we were down for just a second. So kind of curious what you did with that trade, Kurt. And if you didn't roll it, I think I would just close it. Take your profits, move on. And then eventually, if we get a pullback, go back into the stock again. But if it takes off from here, it takes off from here. And there's not much you can do about it. I think you're getting a little bit overextended in FedEx, and it's time for a pullback. Okay. Amazon. So Amazon, I think I can get a little bit more bullish on. Any questions on the Google trades? And is there any way that you want to lean? Which way do you feel like you would lean with Google? Would you go into the bearishness right now? Or would you want to lean into the bullishness? Today, the stock is down 2%. We're heading into earnings. The 2% gives a little bit of an opportunity to the upside. The fact that we sold off just a tad going into earnings. All right. Amazon. Okay, so a lot more choppiness in Amazon. 20-day moving average. We're just hanging out right between, it's a solid stock. The company looks good. So this little bullish crossover here down here really was a catalyst for Amazon. This is the 200-day moving average. You had both the 20 and the 50-day. Stock has came all the way up. We've breached the 200 a couple of times, came down when bought, but it's definitely providing some area of support for it. And we're in this period of consolidation. If I'm going to look at Amazon, and I expect to hear just new things that they might be doing in their AI space, I am going to get long Amazon. And what's fun is you have 1 day for this option to live. So that also means you got to be on it. Your brokerage firm, if you do this trade, we're going to go 2 days out. We're going to lean bullish, and I'm going to go a little bit wider on Amazon. I'm going to spend a little bit more money than I did on Google. We'll probably have a $3 or $4 trade. I'm going to go 20 points wide. So first of all, the expected move is the same. Interesting enough. So we got 132 vol. Extrinsic is 950 and 930. So we'll call that 19. 19 points, which is going to put us at 19. Let's call it. Let's just say it's 20. 20. The strike would be 257.50, which once again, I'd like to highlight this right around the 20 delta. So let's get nutty here. Let's go 245, and we're going to go all the way up to the 260. Give ourselves a lot of upside, and we're going to sell that. And then we got the then we go 67.5. So that's half of the width of this. I'm going to buy that. 312. Yep, I'm going to pay a little bit more. Yeah, there we go. I like it. So here we go. We're going to send this to the what if calculator. If we have a lot more room. We're going to give ourselves some more room to run. I'm a little bit more bullish on the potential to the upside on Amazon. So $3.13. If it blows through our numbers, which means it goes more than a 1 standard deviation move, it goes all the way up to the 10 delta, 10% chance of it reaching that strike, or at least being 1 cent in the money. If it blows through all of that, we're still profitable on the trade. And so if we go back to the what if calculator, it's showing that we're paying $3. It's worth 7.5. So we can make 400 on the trade above and beyond. 438 is what it's saying at expiration. And so the width between the long spread is 15 points. The width of the short spread is 7.5 points, meaning this has to trade for at least 7.5 if the market blows through the strikes to the upside. And then if it does trade at that, you paid $3 and they're saying 15 cents approximately. We'll make it 3.15 for the official paper trade when I take my screen grab here. And then that means the difference between 7.50 and 3.15 is the profitability above and beyond our strikes. Now, the highlight here is that we got a long spread. We go all the way from 245 all the way up to 260. We're 15 points wide on that long spread. Still got to be profitable on the trade, but that means that we can make 1,000, well, right here, 1,100, we'll call it $1,190 right at that strike. But anywhere in between here, it gives us a lot of room and a lot of play on the way up. We still got a high probability of it reaching the 260 level. I think we got, what delta did we sell? We got a 17 delta, a little bit more than the 30, a little bit lower probability, but with the earnings, Amazon does move around earnings quite a bit, a little bit more than Google does. Yeah, I like it. Open wing butterfly on Amazon 1 day to place the trade. Now, I would look to put the trade on tomorrow. Wait to the open tomorrow. I don't mind that you do it today if you wanted to, it's all set up, that's fine. But you would take the same type of principles. We're going a little bit in the money. We're staying within the expected move of 19 points. And we're targeting the strike a little bit higher in Amazon than we did in Google. And then you have the 267.50. So you go 1, 2, 1. And we have limited known risk, $3 to the downside, $315 per 1x2x1 butterfly. For each one that we put on, $315 is our max risk minus any fees and commissions. And that is the way that I'd like to trade it, looking at this. Now on FedEx, if we go back to our portfolio, we bought this option at 37. It's now trading at 42. Oh, that's JP Morgan. Actually, I already sent FedEx to the floor. Let's look at the orders. So, JP Morgan bounced back on for us too, and we're in risk of potentially getting called away on that one. But that one isn't as scary as FedEx. FedEx 335 is what we sold. 280 is what we bought. We're trying to get out of the position because it got away from us. The 335 strike is way too deep in the money to try to roll it now. We close a position, hopefully the stock to come off, and then we would go back and buy back in if we wanted to stay bullish on FedEx. Should have rolled it on Monday. We didn't roll it on Monday. oh well. 361.88 is where the stock is at. So very strong. Well, now it's down just a little bit on the day, but very strong move on FedEx. So we have this order in, and let's click on it, and we're going to replace it. We're trying to sell it at 59.15. Midpoint is 58. That's sad. I guess we'll do 57. Sad that the market moved on us a little bit. It shouldn't be moving much because we're way deep in the money on both of them. This option contract expires at the end of the week. Next 13th. Yep, on the 13th is when that option contract's going to expire. So let's hit replace. Let's make sure we get this filled. All right, that order is sent to the floor. Hopefully we get that filled before the end of the day. Very good trade on FedEx. Meta, we're down 50% on that. All right, let's close the Meta trade. And now I'm choosing to freeze. All right, we'll just move on. Okay, how come I'm moving there? And here's our Netflix trade. This is down to 7 cents on our option contract. So with that said, we'll probably close this one out. We go into the 13th on this one too. And then we're going to sell another Netflix against it. NVIDIA, we're hanging around down about 30%. And we have our order in on Uber, but Uber really isn't doing too much here. This might be an opportunity to buy some Uber. That's an interesting one. And Walmart is doing well, up 48% on that position. You're still in FedEx. All right. So if you sold the call, Kurt, you got to think about maybe getting out of the trade. There's not too much to do with it. You could maybe, if you think that it could pull all the way back, that's fine. Or, I would close out the whole position because our deep in the money option contract on FedEx, Kurt, has a delta of 1. So if we're going to do anything on that trade, now let's go back to the order mask. If we're going to do anything on that trade, we would be rolling this one up anyways, because when the long call option gets to 1, you would roll it and roll to an 80 delta. So this option contract getting to 1, we would already roll. This option contract we should have rolled on Monday. And if we didn't roll it, Tuesday would have been the day, but we didn't have a show on Tuesday. That's when it hit the 335 level. We talked about it on Monday's show. When this happens here, though, the market has gone too far. I would just close it out and then look to go back and buy a higher strike in FedEx, limiting your risk again. But that's the concept of how to manage the trades. Whenever the deep in the money option contract gets to a delta of 1, you roll it, take some profits in the FedEx, and then you move on to that position. All right, 11:30. That's it for this edition of Options Guy TV. 2 trades. The 2 trades we're going to focus on. I'm going to say the official paper trade for the Google is going to be the long butterfly, but it's definitely the long butterfly in Amazon. They're both open wings. They both have unlimited. They both have good, solid potential if the market does move to the upside, and we're going to put those trades on, and that's going to be it. See you on Friday for another interesting day on Options Guy TV, centered around all of these earnings. 11 a.m. Eastern time. Hope to see you Friday. Have a good.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.